Now we're going to move more into a little out of the psychology, and I'll try and drop some little tidbits along the way, reinforcing psychology. Excuse me. This next section, to me, is probably one of the most dynamic features of RSI, the ability to identify trend, uptrend or downtrend through range, through moving averages. Many students have come back to me 5, 10 years after initially taking the basic course and saying the range rules kept me in trades longer than I probably would have. Helped me to see helping and having the range rule shift indicator as a sentiment change and a directional change helped me get out of a trade before it changed direction. A shift from down to up helped me position myself in a trade that was about to emerge as a big winner on the upside. The moving averages on RSI help to reinforce not only direction, but also serve as support and resistance along the way. And we're going to cover in this section 2 what I refer to as the acceleration factor. By the term and the word itself, acceleration, it means movement, strong movement in one direction or another. When you focus on identifying a trend, that's step 1, and identifying trend change. That should be your primary focus. Which way is it running? Up or down? As we said before, sideways markets will do nothing more than frustrate you because you're tying your money up in a place that should be in somewhere else. With the range analysis, you're able to see and stay with the trade longer and see the longer term potential of the trade. But knowing that you've gone from a market which is in a downtrend to one which is in an uptrend helps you through range analysis. It helps you to understand a different focus. There's a different set of rules. If we're in an 80-40 range, we should see bearish divergence. We should see positive reversals. We see the range shift to down. Now we have to change our sentiment and our temperament as far as now the game has changed again to where now it's going to be going down. We should be looking for bullish divergences and negative reversals. Most people, when they look at a chart, look at a bar chart and see price action, which looks like it's going up, and then sells off to a new low, and they say, well, it pulled back, and that's a bullish divergence. I can buy. No, it's a detour. If you're short and you see a new low, you say, I'm in the direction of the trend. You're sitting in tune with it. Most people are not in tune with the trend, or they change their tune many times during the week, month. And for short-term traders, I've seen them change direction and opinion 4 or 5 times in the first few hours before lunch. But the range rules will keep you focused on which way the trend is running. The moving averages will further reinforce it as a guideline and a rule. Again, talking about rules. If you try and sell it just because it's 75 on the RSI and it goes to 80 and say, well, it's really overbought now. But studying RSI the way we have, we understand that the range is there to give the market room to move. People are by nature mostly bullish, and they understand rising prices. Buy it, it goes up. The NASDAQ, when it had its run before the bubble burst, it was the greater fool theory to where I'll buy it and somebody else will buy it for me because it can only go one way. Markets do not go one way. The only time they'll run one direction is if you're on the wrong side of the trade. Then it seems like it's just going on forever. But nothing goes straight up or straight down. But the longer term perspective that you have on trend, seeing price movement over time moving higher, the range rules help you to maintain that perspective until you start to see a shift in the range where it goes from 80-40 to 60-20. The first chart that we have on the range rules is range analysis with RSI. Again, 0 and 100 is the value. Normal range is 70 and 30. Number 3, bull range 80-40. Bear range 60-20. And then overbought at 80 and 20. If you recall also, we use the SMA 3 on the RSI 3 in conjunction with the RSI 14s. And that's where the 80-20 also helps. If you're in a strong uptrend and the SMA 3 drops back to 20, but your daily range is still 80-40, you should be oversold short-term in a long-term uptrend. The reverse for the 60-20 range on a bear trend. You're in a downtrend. It's confirmed with your range. You're seeing the negatives. You're achieving targets. When the SMA 3 rallies up to the 80 level, then you know you're overbought in the downtrend. The 50 level, I did not spend a lot of time with in any of the basic courses. This course we will, because with the CFG that we'll get to, the CRIS numbers, and the RSI moving averages, when the longer term lines cross that 50 level, it tells us something. The acceleration factor, which we'll get into, has to do with the 45 period moving average on both RSI and CFG. The second chart in this section, range analysis, is just for you to review and remember the range shift and what to look for. Where the RSI is trading in an uptrend, section A. After the shift, as it starts down and comes back up in section B, it doesn't really get much above 60 and then stays in the lower half. The bottom chart, the 60-20, most of the RSI activity took place down between 60 and 20. Then you start to see a break of that upper range at 60 and pullbacks near 40. Just because a market makes a price low, creates a bullish divergence, and has a rally doesn't mean the bottom's in. Remember, we're always talking about previous bottoms becoming a previous bottom. When we break it to the downside, we rally back, it becomes the next resistance level. Or a market that's in an uptrend goes to a high, a new high, sells off to what was a previous top. So price action, in essence, is showing the same thing that the range rules show. But just because you see a bullish divergence and a range shift doesn't necessarily mean, number one, the market has put a low in. If you recall, we talked about bullish divergence shows it's overextended to the downside. It should then be followed by a positive. But it's also what's going to be more readily apparent when you're looking at that chart is you see the bullish divergence and the RSI rally if it rallies above 60 and comes back to 40. We talked about figure out your price cycles. How far did it go up? What's a 50% retracement? If it retraces back to the 40 level with the prices retracing 50%, that's a good indication that if it's for real, it's going to turn back higher. So the first real chart we have in this section is on a September bond. Now, this September bond chart, if you take out your AB, your chart before it with the range analysis with A, B, C, and D marked on it, the different sections, and look at that chart in relation to the price chart, comes pretty close. Actually, if you take it and hold it up over a light or something to where you can see behind it. And I used to do a lot of this crazy stuff when I was a broker. I'd lay charts on the floor so I could get a higher, away from it and see how the range was shifting. But if you take that AB chart and you look at the bonds, you'll see the first part of the chart in March, it was up near the top. And the RSI was above 60. Then it sold off at the end of March and come down and tested the 40 level. Now we're looking at the bottom chart with the RSI. And after it made the bottom in late March, it rallied back up. Couldn't get back above 50. Then the RSI sold to 30. mid to late April. Then the first part of May came back up. And tested the 50 level. Middle of May sold off again. Now you can see that price is continuing to drop, but the RSI is not dropping. If price is dropping, RSI is not, you're starting to get basic divergence. Late May, we made a third stab or second stab in late May to the bottom, and then had a rally all the way up through the 60 level. June, we got almost up to 70 before selling off in July, early July, back down near 30, or excuse me, down near 40. So when we came back down near 40, it was pretty much the first time we had gone above 60 and came back down to the 40 level. So the period from March, where it first started to sell off from the highs in the RSI, down to about the 30 level. Then we came back up in early May to the 50 level and went back down, created a longer term divergence. Then we finally broke up in June. Early June, we broke through 50 and kept moving up towards the 60 level. But looking at the price action made its low in May and then made another low in later May to create that bullish divergence on the bottom. Most traders who follow bullish divergence as a pretty much in the old or the original view of it would say that's a bullish divergence and I'm going to buy. Well, that's okay. You get a rally. You get a range shift going into June where the RSI went well above 60. The best place to buy, if you recall, we talked about you get a bullish divergence followed by a positive, or as I said earlier, you get a range shift. Now, what this chart showed is it showed a bullish divergence down around the 30 level, and actually over in mid-May was like a three-period signal, a three-period bullish divergence, followed by a retest to those lows in late May, even higher on the RSI chart at the bottom. I sometimes refer to this as rising bottoms, where a market is trying to bottom. I'm not talking about price making a rising bottom. The RSI is making a rising bottom. In early June, when it breaks above 50, comes back to the 50 line, then goes up, tests the 60 level, comes back down, and then goes up and breaks the 60 level. You've now got a bullish divergence followed by a range shift. The range shift is more important to me than the bullish divergence. If I had to rank range analysis, moving averages, and pattern recognition as far as bullish and bearish, not positives and negatives, range rules should be your first idea of what a market is changing or not. If you didn't have range rules, you'd say, well, we got a double bottom in price and we retested it. And most people are going to take the low prices made on your bar chart, top chart, in late May and draw a trend line through the lows that were made in early July on just a price bar chart. Just looking at a line being drawn across the bottom. And say, well, we're making a higher bottom in the RSI. We're rallying. Price has rallied. But for me, and for what I look for, That retest, after we rallied from late May on the RSI chart all the way into late June, broke above the 60 level, and then sold off back near 40. Remember I said before, when you see price make a low and then go to a high, figure out how far it should come back as far as retracing. In this case, it went from, the low was about 98. These are a point apiece up to 102. So we had a 4-point move up. If it moved up 4, if it comes back about 2, it's 50% retracement. What we talked about price cycles, take the low to the high, divide it by 8, and get 12.5% retracements. Somebody once told me the greatest rule they ever heard about trading was 50% rule. Whatever the low is to the high, comes back 50%, buy it. Goes to a new high, take that first low and the new high, 50% retracement, that's a good level. Remember I said about drawing a line on close? If you look at the divergence in May, which looked like a little 3-period bullish divergence, look at the low close that was made in mid-May. Look at where the bar chart shows that hash mark where the close is. Draw a line across the chart. Then look in late May where it came back down and made a higher RSI bottom. The price bottom was about the same. And the extreme low, the day after the extreme low, look at the next price bar. Look at where the close price is. Draw another line. You'll start to see what should be price support action. But you're basing your bar chart points that you're going to draw on RSI points, not subjective. Anybody who was negative would take the highs that were made in March on the chart, draw a line through the May high in price, and say, well, it's still below that. Then it breaks above it. Remember I said about breaking above a line, coming back down to the line? When you break what was a resistance line, it should then become a support line. What was resistance should become support. What is support, when it's broken, then becomes resistance. So when you draw your lines, and you can base your trend line analysis on RSI points as opposed to basing it on subjective reasoning. The 40 level on that retest, though, the change in the range rules, to me, is much more important than it should be to you, because not only are you seeing a higher bottom in price, and you've drawn on your price bar the low, the extreme low that was made in May off the second low close, latter part of the month at a higher close as your support lines for price. You've got a retest of the 40 level, and if you extend your RSI point trend line from the lows that were made in April you had about a 5 or 6 period signal, bullish divergence. Mid-May, about a 3-period signal, and you extended that line, you'd find in late May it came back and hit that line again. If you extended a little further into early July, the RSI sold off to that line. So it sells off to a bullish divergence trend line, but more importantly, it sells off to the 40 level after breaking 60. Price action's trying to put in a higher bottom. The RSI is trying to turn up. The range rules are trying to shift. The rally that takes it up into June, late June, the RSI got all the way above 60. And then in July, after the retest of 40, went back above 60 again. We had a little sell-off in late July and early August. But look at your price points. Look at where your bar chart is. You should be seeing positives in there longer term. By that time, your moving averages have already shifted to the upside. So you've got range rules, moving averages, and now positives. We have range, moving averages, and pattern recognition coming together. To me, the safest place to buy is around that 40 level. Because the market can do whatever it wants down below 40. It's still in a downtrend. It's probably still got negatives pointing to lower levels. But in early July, after breaking above 60 and coming back to find support at 40, tells you that you're pretty much turning the corner. And that you've gone from the 60-20 to probably what's going to be 80-40. So the significant low in price, the extreme lows in price that were made in May, that's a low. If you want to be aggressive, and this is where the edge helps, the stuff you learned today help. If you want to be aggressive and you've been short that market, this is not a point where you take off half. This is a point where you exit the trade. So it's extremely overdone. We've got multiple divergences. We could have rising bottoms. And we've got charts in there with the actual prices on it. But I'm trying to get you to teach and help share with you the idea that if you look at a bar chart after you look at an RSI chart, not before. If I'm only looking at the RSI and I've seen it was above 60, did not break 30 in April or May. April it was hitting around the 30 level. May was not. And we started to get a rising bottom formation out of it. There's actually a wedge or triangles and anything else you can draw on these. But the range shift is much more important. And once it turned up from that 40 level in early July, we never really looked back. You started to see bearish divergence across the top of the chart in the RSI in July. In August, longer term divergence in September. Now we're going to mark these charts together, and I'm going to teach you something that's very simple. I love trading bonds. A lot of people trade certain markets and like trading those. Bonds being in 30 seconds, you got to have your wits about you or a calculator to figure out how many points it's going to go. But if you round them off, and you look at the April lows that were made in price around the 100 level. And after we had price down at the 100, that first rally up to the 50 level, price got up to about 102, which is where the RSI was early May, when it was at the 50 level. The highs that were made prior to that in early April were around 104. So you can see in early April where price got up to about 104 or 104. And in early May, it was 102, but we have longer term, negative reversals showing. Okay? If that's a negative of 2 points, and it's like I said, we're not getting into the specifics of, was it 102 and 3 30 seconds, or was it 102 and 4 30 seconds? Just round it off. Look at your bar chart above it. Say we made a lower high in price. The RSI showed a longer-term negative. The negative suggests 104 minus 102 is 2 points. 2 points under the 90, under the 100 low in price that was made in late April, where the RSI was down at the 30 level. Said that bonds should have gone down to about 98. They got down to 98, roughly 98 and a half in late May. Mid-May, where it looked like we had a little 3-period or 2-period bullish divergence. It was actually 2-period. Because you're looking at the bar chart, You see the first low that was made in mid-May, and the RSI was trying to make like a little bullish divergence. That 2-period bullish divergence was around 98. Your target was around 98. You're achieving the downside targets. But the RSI is not going down with price. Remember, price and momentum should move together. So price was going down, but momentum was not really solidly behind the downtrend. We rallied above 50 off the little bullish divergence in May. Rallied back above 40, and came down for another attempt. Remember I said about drawing the price bar where the low is. Where the low was made in price, the extreme low, drawing your price bar across. So you retested that level again. But this time the RSI made a third higher bottom. Now when the market moves up, we have to look and see, is that a real bullish divergence? If you look in March at price action where the RSI was above 60, the price was about 107. So we went from 107 down to 100, or down to just below 104, then came back just to the 104 level before we went down and started to create all the bullish divergence. But we had a negative that showed up that said it should go to 98. We had the price extreme low in May that we drew a clothesline support. That's what I like to really call it, is a clothesline support level. It retested that but didn't break it. So we were not going to new lows. Remember we talked about what do you do when negatives fail or a positive doesn't achieve the target? You start watching to see if it is achieved. If you have access to intraday data or even just watch the highs and lows. Do you remember pivot points? Suggesting pivot points? If we had a pivot low that was not being broken. You don't have it breaking the pivot low. You don't really have it going much beyond the projected negative reversal target. So it seems like the momentum is slowing down. But as I said, round numbers, somewhere around 98, right? So it gets down to that level and doesn't penetrate it by much. And the first rally in in June, we get the range shift to where in late June it goes all the way back up to the top of the chart, which was about 102, maybe 2.5. And it got higher than it did in May. But the ensuing sell-off that tested the 40 level, price action only came back really to about the 100 level. But what was our low over in May? The secondary low was around 98.5. Again, round numbers. 98.5 and 100. It's a 1.5 different. Now you got support at 40. Your moving averages are probably already turned up. Buying at 100 in July is a hell of a lot safer than buying at 98.5. Because you've got more technical probability of a trend change. Somebody says to me, in May, bonds have a bullish divergence, could be bottoming. My first response is that's a possibility because we got negative reversals that are failing to hit the targets and go beyond them. They say, are you buying? You say, well, if you want a quick trade, yeah. If you made a lot of money on the way down, you might be a little bit more aggressive. But the trade that you can put on and walk away from is not the bullish divergence in May, July. Range rules have shifted. It looks as if you do have, even though it's not a classic positive reversal, you got the RSI finding support at the 40 level. it's already broken the 60. If you look at the bar chart at the top, when it hit 102 in late June, the peak in the price action, look at the highest cross mark you have up there, where the highest high, the close, was around 102.5. It was actually, it was closer to 102.5. So you're starting to see price action move up. But what happened the following day is it rallied above where you drew that clothesline resistance and sold off. But when it sold off, it found support at the 40. Now you're looking at the bottom, the RSI is saying, well, it should be about 1.5 points higher, which means 103.5, roughly. The old adage of keep it simple, sometimes the best targets that you can set with RSI are rounding the numbers off just to give yourself an idea. But by giving yourself an idea that we could have a potential move up to 103.5. But the high in late June, was only 102, where we drew that clothesline resistance, where we extended the line across. And after it started to move in July up through there, you're looking at a target of about 103, but you've got that clothesline resistance where you should expect to see it break, right? You're setting positives up there. You've got a trend clothesline resistance. Market goes up in July, almost gets to 104. You start to see like a flat bearish divergence or a multiple three-top divergence, bear D, and you get a sell-off. But look at your price action in July. Went up and broke the clothesline. Rallied above it and came back to it later. And when it came back to it in early August, the RSI never even dropped back below 50. That's why I say, if you're going to buy off a divergence, you better have some short-term charts that are showing positive reversals. If you're going to wait, because I know some people really like the range rules, and look at it and say, it's trying to make a bottom at 98.5. It's showing that it's really trying to make a bottom now at the 40 level. You buy at the 40 level on the RSI in early July, start putting in buy orders, you're going to sleep, or should sleep, a lot better buying in July than you were in May, because you have more reason to be long. In May, you're saying, I think it could bottom. It might be a double bottom. Well, there's double bottoms that come and go. Some work, some don't. I wouldn't trade off of double bottoms. I hear W's and M's and everything else. The range says you could have a rising bottom in April and May. The retest to the 40 level in July says we should be seeing this thing turn higher. You have a better trade in July versus May. You know what your risk is, because your risk is where you drew that clothesline support back in May, around the 98.5 level. So you know you're going to risk 1.5 points max is what you should risk. I don't like that kind of risk either. But the fact of the matter is, if that is a bottom in April, you remember from basic, you get a bullish divergence followed by a positive to confirm the divergence. The first positive confirms your last bullish divergence as real. Your second positive confirms the first positive. So you get a bullish divergence followed by a positive to confirm the bullish divergence. But that second positive that you get confirms the first one, and also confirms that bullish divergence was probably a major. So you're going to have a big move. Again, this is off a daily. So on an hourly, if you were looking at an hourly in July, it may have even dipped a little below 40. But the safest place, not only the safest place to buy it, the smartest place to buy is July and not so much May. for right now. When we get through the rest of what we're going to go through this weekend, you can see you could have bought in May. If you turn around and see a market try and make a bottom, you see psychology change as well. And in May, when everybody's negative, then in July, less people are negative. Some people are starting to see a trend change. If you get your pullback into support, you know you always want to buy support or near prices of support before you go higher. But you want to identify points of support both in price analysis and also in RSI analysis. This one at point around the 100 level in early July gives you both. When you see the market break above, like in June, excuse me, in early June when it rallies through the 50 level and then starts to move up to about 55 and then comes back to 50 and then goes back up to 60. Your first break of the 60 level versus when it first breaks to 50, you can buy on this retest after it's broken 50 on the way up and starts back down. If you can give me another reason to buy it, a break of that trend line, a lot of people are going to be buying a breakout. But when you break to 50, since it's the first time you've broken above 50 since April, you really want to be sure that you're going to be able to take out that 102. Because that 102 was a negative that said 98.5. Now, when we talk about taking the highs and lows, this is why I said what you learned in basic of range rules, moving averages, and patterns. When you see something start to develop like you have in May, is when you start to really do your homework. Because the move from the beginning of the year into May was a downtrend. Prices were going that way. Chaos and confusion start in April and May. But then the market starts to put that rising bottom in. If you go back to early May, where it was price was around 102, 104 in early April, 107 in late March, and do your cycle work, your price cycle. Figure out the 50%. Figure out the points along the way. What's the 50% retracement? What's the 62.5? What's the 75? Right after May, when you start up, you may be breaking the 37.5% retracement or coming up near the 50%. From 98.5 to 102 is 3.5 points. So 1 3/4 points would have been 99 around 100.5 or about 100.5. Well, we see the price action off the lows in May come up, get through the 100, get through the 100.5, and on that first pullback near 50, if you're using short-term moving averages on RSI, they've already turned up. The 9 and 45 could be in the process of turning up on RSI, but they may not have seen enough upside action in price to turn them up on the closing moving averages. But you have a high confidence it's trying to do something based on two things. One, a rising bottom in RSI. And two, when we drew that clothesline support off the close of the last low, the extreme low that was made, shows price support. You could even say there was a little wedge during the month of May in price action, which it broke out of. But when it starts to turn up, the fact that it's crossed the 50 line after being so below the 50 for so long, it crossed the 50 in early June and came back to it. So if you bought on that pullback, you just have to use a good money management stop. Or if you figured out from the lows that were made in late May to the highs that were made from late May to early June. And that little pullback, usually when a market starts up, it only pulls back for a couple days and then goes up again. Pulls back for a couple days and goes up again. But if it's not really turned for sure, it might go up for a couple days and give it all back in the next couple days. But as long as it's holding on to the gains from the price lows that it made before, it's usually a good indication that you're starting to turn.